Welcome back to my pencast sessions for Chapter 5 on inventory. Good to have you join me again. I really do appreciate your diligence. I make these because I think they will help you be successful on the final and on your tests and to learn accounting. And so I appreciate you taking the time to join me. Let's figure out a goal for this pencast. Our goal is to examine how inventory fits into the accounting cycle, or stated another way, how it changes what we're already doing as far as the accounting cycle goes. We have already learned how to record or journalize the purchase and the sale of inventory during the course of the month in the first step of the accounting cycle, analyzing and journalizing transactions. There's not much to learn about how to post into the general ledger. There's just a few more accounts to post into now. Nor is there a lot to learn about what's new on the unadjusted trial balance. The only difference is we have some new accounts: inventory, cost of goods sold, sales returns and allowance, and sales discounts. So we've pretty much mastered the first part of the accounting cycle. That leaves adjusting entries next. As you'll recall, from Chapter 3, we learned several adjusting entries, and there is one more we need to learn for inventory, and so we need to learn the adjusting entry the inventory causes, and there's actually two, one in this chapter and one in Chapter 6. So one of our goals needs to be to look at how we do an adjusting entry in this chapter. Once you've done adjusting entries in the general journal, the next step is always to post to the general ledger. Anytime you make journal entries, you post, and then you check the accuracy by making a trial balance, and in this case it would be an adjusted trial balance. Once you've made the adjusted trial balance, the next step is to make financial statements, and you still need to make the income statement first because you need net income to make the statement of changes in owner's equity, which you need total of to make the balance sheet. And we'll have a separate video on making financial statements. I think it'll be the easiest way to cover that topic. Once financial statements are made, the next step in the accounting cycle is to make some general journal entries to close the accounts. And so we need to learn as our second project in this pencast how closing entries are affected by inventory. Closing entries are, of course, posted when they're made, as all entries are, into the general ledger. And from that, you total the accounts and prepare a post-closing trial balance. The only difference on that is you're going to have an inventory account now. So two goals in this pencast then are to learn how inventory fits into the accounting cycle by way of the adjusting entry that it causes and how it affects closing entries. Let's start with adjusting entry. When you hold inventory or use it in your business, it has a tendency to have some shrinkage, whether that's from theft or from breaking or from spoilage. Hard to say. But you record all of your purchases, take out your returns, you record your freight, you subtract any discounts you might have taken. You do this all month long, or the whole period long, and you end up with a balance in inventory. Let's, for the sake of this discussion, say ours is $10,500. You go out. The next step then is to go out and to take a physical count. Generally accepted accounting principles require that you take an inventory once a year. To verify this current asset, it's one of your largest current assets, we need to have an accurate balance for it. So let's say you go out and you take a physical count. When you take this physical count, you determine that there's really $10,400 worth of inventory on your shelves, not $10,500. You've in fact had some inventory shrinkage. The adjusting entry that we need to learn to make then is to deal with this shrinkage. We need to reduce inventory by $100. The way we do that is we make a journal entry and we say, let's debit cost of goods sold for the amount of the shortage, in our case $100, and credit inventory for the amount of the shortage, in our case $100. When you post this, it will drop the inventory down and have the accounting records match the physical count. So the entry, the debit, as long as it's a normal shrinkage amount, is into cost of goods sold. The reason is, a lot of people think that holding shrinkage is a normal cost of holding inventory. There's a normal amount of shrinkage that you could expect to happen. If your shrinkage exceeds that amount, there are other accounting techniques and probably insurance claims that will be involved. But for normal inventory shrinkage, we post into cost of goods sold in the period it's discovered, and just let that become part of cost of goods sold for the period. So that then takes care of adjusting entries. Interesting, isn't it? Number 2, our second goal, was to look at how inventory affected the closing entries. And so we'll do that next in our little pencast. Chapter 4, we learned that there are 4 normal closing entries. 1 is to close revenue into income summary. 2 is to close expenses into income summary. Number 3 is to close income summary into the capital account. And number 4 is to close draws. How does having inventory affect this? Well, as far as our first entry goes, we now need to close an account called sales revenue. Sales revenue would, of course, have a credit balance, as all revenues do, and we would debit it into income summary. So the only thing that changes with inventory on the first entry is the type of name, or the name of the account we close. It's not service revenue, it's sales revenue. As far as closing expenses go, it's expanded a little bit. We need to close all temporary accounts with debit balances. Now these, of course, are closed into income summary, but there's a few extra now because of inventory. One of the extra ones is sales, returns, and allowances. That is a contra revenue account, so it has a debit balance. Because of that, it gets closed with all other debit balances. The same can be said for sales discounts. It's a contra revenue account, and it needs to be closed. And you close all your expense accounts since it has a debit balance. And cost of goods sold. Cost of goods sold is just an expense. It's expense of selling the product that you have. And so it gets closed into income summary. And then all your remaining expenses get closed normally. So the only difference is we now have sales returns and allowances, sales discounts, and cost of goods sold being closed in the second journal entry. The remaining entries remain the same. They are unchanged. You still close income summary into capital, and you still close the draw account into capital. So the only 2 things that change are change in entry number 1 from service revenue to sales revenue, and in entry number 2 you got sales returns and allowances and sales discounts and cost of goods sold expense into the temporary accounts you're closing with debit balances. That's it for for how inventory fits into our accounting cycle, with the exception of financial statements. They're up next. Thank you for joining me, and I hope that you have a real nice day, evening, or whatever it is you're up to. I'll be talking to you before long. Now you take care of yourself.